everyone. Welcome to the Business Growth Pod. I'm your host, Allan Draper, as always. I'm excited for our episode today. Before we get to him, do me a favor, and if this episode resonates with you, there's something in it that you think that somebody else could get something from, or even a previous episode of mine, make sure to share it with them. That is a great way to say thank you to me. That's one of the best things you can do, is share this with a friend that could get something out of an episode. I appreciate that. My guest today is Brad Blazar. I'm excited. We get to talk about money today. He is the former CEO of a small oil company, and he is currently a highly sought after speaker on the subject of raising capital. So we're going to get into that today. Glad to have you, Brad. Welcome to the show.
Great. I'm just excited to be here with you today, Allan. It's always great to be on shows and share knowledge and impact other people's lives. So thanks so much for hosting me this afternoon.
Yeah, absolutely. I speak to entrepreneurs. I speak to people that are trying to get started, and making sure that they're properly capitalized is one of the common issues with startup entrepreneurs. So we're going to get into some of those details and hopefully provide some value for these folks that are trying to get to the next level. So before we get to that point, why don't you tell me about how you became an expert in the realm of raising capital?
Yeah, no, I'd be more than happy to. It all started for me really early in life. I was going to school actually with the goal of becoming an architect. I had no knowledge I'd be doing what I do today. But when I was in school in my fourth year, I was circling ads in a newspaper one day, just looking for a job. And I stumbled across an ad that really intrigued me. It was a small oil company in Austin, Texas, and they were looking for people in sales. And so I called up. The next day, I get a phone call from the CEO, and he invites me to come in for an interview. And he just took a liking to me. I mean, I was a sharp young kid, could think quick on my feet, was real confident, probably kind of cocky. And he said, Brad, I'd love to put you to work. Here's what we do. We raise money from high net worth individuals, and we take the money, we go out and we explore for oil and natural gas. And, your job is going to be to get on the phone and build trust and build rapport and explain our programs to them. And we're going to pay you a handsome commission on all the sales and all the money you raise. And so I went to work for these guys at the age of 21. Basically going in between classes after school, maybe working 12 to 15 hours a week. And I got real good at it. I was making close to $100,000 as a 21-year-old kid. And so I'm sitting there going like, what am I doing going to school to graduate with a diploma to go out in corporate America and essentially get a, $50, $60, $70,000 a year job, when over here working literally 12, 15 hours weeks, I'm making $100,000. And so like any kid, what I did is I basically kind of turned my back to school, not finishing my education, went to work for a second company doing exactly the same thing. And then basically about a year later, printed up some letterhead and business cards and took a real bold, ambitious step and started my own oil company. And, I had never drilled an oil well. I knew absolutely nothing about managing or running a business, but I knew how to attract and raise capital. And so over the course of about a decade, I built up a pretty nice sized company. We had about 35 employees raising millions of dollars a month. And then in the late 80s, a couple of things happened that forced me to shut the doors. And so I collapsed the business and basically went to work just, raising capital for other people and my own deals. And to date, over 35 years, we've raised roughly $2 billion from conceivably every source you can fathom: family offices, high net worth investors, institutions, et cetera, et cetera. And that's why I guess around the world, people kind of refer to me as the $2 billion guy.
It's a lot of money. It's a lot of money.
It is a lot of money. When you really look at it, it is a lot of money, but that's over a long period of time. And, the biggest check that I've picked up was 25 million That was from a large office. Along the way, there's been, multiple $1 million checks, 11, 9, 10.
Hmm.
It adds up quickly when you're getting it at the institutional level, but it all comes down basically to some core key fundamental concepts that, you need to understand about attracting and raising money. And what I found in my journey and conversations I've had with people is knowing how to attract and raise capital really needs to be like the superpower for any business owner, any entrepreneur, really anybody, because it really opens the door to you being capable of
Hmm.
doing something much larger with your life. And it's my belief that most people have a desire to be doing something bigger. They either want to start a business,
Hmm.
they want to scale the business they may already have, maybe they want to get in real estate, but it always comes down usually to one reason that they're not doing it, and that's the lack of money. They just don't have the money. But what they don't realize is they don't need the money. All the money you need to do anything in life pretty much you want to do exists. It's just called OPM, other people's money. And you just
For
have
sure.
to learn how to go out and attract it like a magnet, have those conversations with people. And then once you learn a few key secrets, it's
Hmm.
magic.
That's interesting. You said something about, most people and all business owners. So you're saying you think all business owners should raise money?
Not necessarily should raise money, but they should know how to do it if they need to, and should have an understanding that, quote, that's an option for them. Raising money and, quote, having the obligation of being a fiduciary and, working with investors, it does entail work. It is obviously a responsibility because the
Hmm.
people that are investing obviously expect you to do good by them and generate a profit. But it's not something that, quote, every business owner should do. But I think at some point in every business's growth, there is a period where the owner or the entrepreneur is like, man, if I just had access to more money, I could hire up some more salespeople, or I could expand my office, or I could, go out and make a strategic acquisition that complements my business and allows me to 2x or 3x much quicker. But it's really just an option. Most people, when they need money, what do? They go to the bank. That's kind of the traditional route. They take on more debt. They're obligated now to a stream of payments. And we all know if you can't pay back the bank or you can't pay back the SBA, there are rights of rescission. They can come and they can foreclose and they can do bad things to you, right?
Hmm.
And so when you work with investors, the great thing working with investors is they have none of those rights. I can't tell you how many deals I've been involved with over the course of my career where we told the investors, hey, we're going to have a targeted distribution and pay you 7%. And so we're paying them 7% for a couple of years. They're getting a check every month or every quarter. And then we go into a recession or the economy turns against us and we send them a letter and say, hey, we're in a recession. We had to lower the amount we're collecting in rent and we can only afford to pay you 5%. There's nothing they can do about it. Now, if you do that to a bank and say, hey, my monthly payment is $650, how would it be if I just paid you $425 every month? Probably be a little bit different conversation.
Yeah.
And so, investors are big boys and big girls, especially if they're accredited, which means that they're a person of some substance and they understand the risks that are involved in any potential investment that they might make. But the key thing that I always explain to people when it comes to raising money is you need to be transparent about the good, the bad, the indifferent. Imagine you're a doctor. You walk into the operating room, you do everything you possibly can to save somebody's life, and unfortunately, they die on the table. Well,
Yeah.
you've got to share the news with the family, and that news sucks. But
For
imagine if
sure.
you're, in the oil and gas industry, you take someone's money, you go out and you drill a dry hole. What are you going to tell them? It's the same thing. You just lost every penny that the guy gave you, but you can't sugarcoat it. You've got to be transparent. Just say, we did everything in our power to bring in the well. Unfortunately, there was no oil under the surface of the earth. We're going to do another one. And we use the best of the best. And if you're honest and you're transparent and you communicate, what you'll find is you build that trust over time. And many times people that have discretionary wealth or have an abundance will continue to invest with you because they realize that you treat them with honesty and everything you do is tied to integrity.
Yeah, that's interesting. That's interesting. I'm actually, to be frank with you, I'm torn. I'm torn on different, revenue sources. You know, um I think it really depends on the situation of the entrepreneur. I think there are some businesses that they need to raise private capital in order to grow and to meet the vision of the entrepreneurs. And I think there are some that they're better off just saving money for a while and starting it themselves. You mentioned the goods and the bads and making sure that people are aware of all of these things. You use the analogy of, the surgeon having to tell a family that they lost somebody. In addition to the kind of this, going back to an investor with your tail between your legs and, saying, hey, we lost the money. Um, I can't imagine doing that. But what are some of the other issues? What are some of the other pitfalls? What are some things that people should kind of be on the lookout for before they get into a type of deal where they're selling their company, essentially?
Well, it's not quote selling the company. There's certainly different ways to structure working with investors. You can do it as an IOU where it's more debt. Hey, you give
Which
me a
is
hundred
that's a lot
thousand.
like a bank, right? That's a
Yeah,
lot
yeah,
like going to a
exactly,
bank.
exactly.
Yeah.
So hey, you give me your money, I'll make a series of payments to you over 3 years or 5 years, and at the end,
Mhm.
there's a maturity date, and I'm going to give you all the money back. And then, of course, the other, like you were kind of alluding to, Alan, is you give up a little bit of equity or a little bit of ownership, and a lot of investors like that, because they get the upside appreciation, and they get to participate with you that way in the growth of the business. But what a lot of people overlook is when you're raising money from other people, whether you realize it or not, you're essentially in the securities industry. And so you have to
Mhm.
have a pretty good understanding of, kind of the do's and the don'ts, what you need to be cognizant of as it relates to the SEC and various state regulators. But there was a Supreme Court decision many years ago. And this is basically what regulators look at. This is what, a plaintiff's attorney is going to look at. God forbid the investment doesn't work out and, you end up finding yourself in arbitration or worse yet, in a lawsuit. But there's a test, and they call this the Howey test. And so in a Supreme Court decision, they basically established 4 criteria to determine whether somebody investing with you is investing in a investment contract, and therefore that investment contract kind of falls back to having knowledge of the securities industry. And those 4 things are basically: number one is there an investment of money, which most of the time there is.
Mhm.
Number two is that investment in a common enterprise, right? Is it in a common enterprise? Am I investing in a business? Is there a common enterprise? Which again, usually there is, with the expectation of a profit to be derived from the efforts of others. And that's really the key distinction here. You see, when you give somebody money to invest and that person says, hey, we're going to take your money and we're going to do this with it, there's the expectation of a profit, but that profit is being derived by the effort of other people that have the
Mhm.
knowledge of the industry or the knowledge of, quote, whatever it is they're going to do with it. Well, those 4 things define a security or an investment contract. Now, if you're raising money yourself, you don't need to be securities licensed. There are different exemptions because you are the principal. But once you start looking to have other people help you, you got to be knowledgeable of how to compensate them, because if you pay them a commission, it's a big no-no. And so there's different exemptions that people need to be knowledgeable of as they go out and they venture out to begin the process of raising capital. The other thing is most people say, yeah, I want to raise money. They get the money, but then they never think about what that really looks like. If you don't communicate to an investor over the course of 3, 4, 6 months, that investor is going to start scratching his head going, I wonder what old Allan's doing with the money I gave him 6 months ago. I haven't heard a damn thing. I
Exactly.
have no idea what he's doing with my money. So I always explain to people, you got to think of building the foundation. At a minimum, think of a quarterly newsletter or a quarterly investor webinar where you're just updating people on what's going on in the business and what you're doing as a company. They like to hear that stuff, because if you can do that and you can basically satisfy their need for communication, what do you think they're going to do? If the investment's performing and it's doing well by them, they're going to go out and brag about it, and they're going to go out and tell their friends. And before you know it, you're getting a call. Hey, Allan, I got a golf buddy that I was talking to the other day that's real
Yeah.
interested in talking to you. You see, and
Mm.
now it's not you trying to convince somebody how great and wonderful you are. You now got other people doing it for you. And
Yeah.
that's when raising capital becomes even easier, because now you've got basically a warm referral from somebody, and that person trusts them. And therefore, it's going to accelerate the process and enable you to raise money that much easier.
Yeah. That's interesting. Is there a minimum amount that you would recommend somebody be looking for in order to raise private capital?
Not really. I've got students that literally are all over the map, and we've got students in countries all over the world. Some of them are just trying to raise a couple 100,000 to, fix and flip single family homes or start a business. And of course, others are, trying to raise much, much larger amounts of money. But when you look at, what you're trying to do, to some extent, that largely dictates the types of conversations you're going to have. It largely dictates how much money you're going to try to raise from other people. For example, if you go to any one of these real estate gurus and you learn how to, flip houses, you know that you're going to go out, you're going to find a house that needs to be rehabbed. You're going to go walk through it with a contractor, figure out what you need to do. You got to rehab the house, put in some new cabinets, upgrade the appliances, yada yada. And let's say the GC says, it's going to cost you $60,000. Great. I don't have it. So now, though, your goal is you got to go out and find $60,000 from whoever, friends, family, investors. So, if somebody can give you 20 grand, well, that's a good thing. Now you only need to raise 40 more. Somebody might say, I'll give you 50. That's even better. So the needs of the raise and how much you're trying to seek are largely dictated by the business or, the situation. But if you're in a business like I am, where you can launch a fund and basically just say, look, we're going to raise $25 million this year and use all the money we raise to go out and buy multifamily properties. Now the conversation with an investor is, hey, you're investing in the fund. The fund is going to own a diversified portfolio of 4, 6, maybe 8 properties, and you're going to own a small interest in each and every one. A lot of people like that because it's diversified. They don't have all their eggs in one basket. And so it really just depends on the entrepreneur. It really just depends on each individual's situation, the business itself, what the business can support in terms of commitments to investors. And so all of these things largely come into play. But at the end of the day, it's my belief that, most entrepreneurs, most investors, most people should at least know that other people's money is always an option, and also understand some of the processes and some of the concepts that they need to have in order to go out and pursue that, if that is the alternative that makes the most sense for them.
So at what level would you recommend somebody reach outside from friends and family to kind of private money?
Well, here's 2 things. Number one is, I personally myself do not recommend raising money from friends and family. I've never done it. And I've raised, $2 billion for
Why is that?
my own and also for other people. But here's the reason that I don't encourage people to raise money from friends and family. We all know that our economy is cyclical, right? We go into recessions, we come out of recessions. We all know that certain industries are cyclical. Real estate prices go up and then they come down. It's all based on supply and demand. Well, how are you going to feel if you take $50,000 from old Uncle Henry, and then the deal you put his money into goes belly up, and now you're trying to hide at every family gathering because you see Uncle Henry coming over to you and you want to avoid having that very difficult conversation, or worse yet, it's a good friend of yours. And
Hmm.
so it's always been my belief that you avoid the friends and family, because I don't want to burn the bridges with a good friend. I don't want to burn the bridges with a family member. That's even more important to me than a friend's money. But I've just never gone there.
Hmm.
And, some people have, and I get it. It's easy money because they trust you already and you already have that existing relationship. Um, but make sure
Yeah,
that
that's an
when
interesting point. Like I think I would rather, this sounds terrible, but I would rather lose a stranger's money, but I would rather make profits with a friend or family
well,
member.
yeah, no, absolutely. I totally would
Right?
agree.
Are you on board with
Absolutely.
that?
I mean, I totally agree with the psychology of that. I mean, if you have a business, for example, and it becomes the next Amazon, or, you hit it out of the park and you're generating phenomenal, 5x returns. Yeah, it'd be great to be able to do that for a friend or for a family member. But then there's always the other side of that, the risk
Yeah.
that, it doesn't work out the way you intend it to. But
I
here's the thing. I always tell people, you have to memorialize and you have to put the commitment from both people in writing. In other words, you're giving me X amount of money. We get that. Put it in writing. And then you, who's getting the money, put in writing what you're going to do. What commitments I'm making to you are this, so that the expectations are established right up front. That way, the person can't point their finger at you and say,
yeah,
hey, you told me this. No, here's exactly what we had committed to. It was
right.
expressed in writing and we both signed this. So it helps smooth things over a little bit, Alan, but at the end of
Yeah.
the day, nothing's perfect.
Yeah, I think that's right. I think a lot of people go to friends and family early because usually friends and family will believe in you when other people won't.
Hmm.
I
Yep.
think they're easier to get money from.
Yep. They are. And that's why most people start there.
Yeah, and I think I and that's kind of why I was asking that question, like what's the level of funds that I'm trying to think for just me personally. Um and I've never raised money. I'm a quasi angel investor, so I do invest in businesses, so people have come to me for funds.
Yep.
um but I think that's a good question, because in some circumstances, I think it's so hard to start with that monkey on your back. I
Hmm.
really do. Let's talk a little bit about some of those deals. You gave this example of somebody that's trying to raise capital. I think you said 60 grand or something. Let's say it's 100 to do a fix and flip business. What's that money going to cost somebody?
That's a great question. So there's two ways to structure that. You can either structure it where you're just going to pay interest and you're going to tell the person, look, I'll pay you back your money plus 12%, or, 15, 20%, whatever, you want to come up with. And the other is basically to split the deal and say, look, you're going to give me the money, but I'm doing all the work. And when we sell, how about I give you, 60% of all the profits we generate, and I'll take 40% for doing all
Hmm.
the heavy lifting and having the knowledge. Or, maybe it's a 70-30 split because the investor's taking on the risk. They're bearing the brunt of the capital risk because they're putting up the money, but you're doing the work. You're meeting the painters and you're meeting the carpenters every day, and you know how to do this. And so you work out a deal where you flip a house or you do something where it's in business, and there's a large number to split up. I'll take 30, 50, $60,000 paydays any day of the week if I'm using somebody else's money to generate those for me. And so it just largely is driven by the situation. A lot of investors are fine just getting interest. Here's my 100, pay me back in 4 months, 120, and I'm happy as a clam. Others are like, no, I know how much your money get over here, so I need a little piece of the action. Okay, great. How about I give you, 60, 70% of whatever we create when we sell. And it really just depends on, who that person is. Like you said, if they're a friend or a family member, they might be more forgiving. They might be willing to, work with you on easier terms. If it's somebody that you don't know, that you've sourced as a traditional investor, it might be a little different. But it really depends. And what you have to realize is that investors are looking for different things. As you get older and you're in your retirement years, you're predominantly looking for income type investments, right? Because you got your Social Security, you got whatever you have saved up for retirement, but you're looking for cash flow. You still want your money to grow, but you're looking for income because you're no longer at a full-time job. You're no longer working. When you're younger, you're looking for growth. You're willing to take on more risk. And so when I'm having conversations with investors, I'm always asking questions. I'm saying, hey, Alan, are you looking for income? Are you looking for some growth? Or are you really wanting a combination of both of them? How important are tax benefits to you? If we could find an investment opportunity that threw off some depreciation or gave you some great tax benefits, would that help? Yeah. You're looking to put this money to work to do something special with it, like put your kids through college or maybe invest in a second home, because the answers you get from that person are going to help you come back later in the relationship and do a much better job of closing the sale and getting them to open their checkbook for you.
For sure. What type of security interests are the investors taking?
When you say security interest, what are you talking about? Like, are they buying shares or are they buying units type thing?
No, like in our example with the fix and flip, are they taking a security interest in that property?
Um, they certainly can. Typically, no. They're not really taking a security interest. I've worked on some deals where they ask for that, and they want something in the form of some type of security, like a deed that they can hold on to. They won't record it, but it just gives them a level of comfort to say, hey, if the deal goes south or I don't hear from you, I know I've got a general worthy deed in my possession that I can file and take ownership of the property. A lot of times, you'll also structure it maybe as a tenant in common type relationship where they're tenant in common alongside you. But most of the deals, if you're in real estate where you're just, flipping, they're such short-term deals where you really don't record anything. You just quote, get control of the property. You go in there and you're trying to get in and out of it in, 45, 60 days. And really it's more in a handshake and just a formal writing, an acknowledgement of some type of an agreement that both parties agree to. If it's a longer term investment, like for example, let's say you're buying a 12 unit apartment building and you know that you're going to own it for 3, 4, 5 years. Well, then, yeah, there's subscription agreements. You're memorializing the investment with paperwork. They're becoming a limited partner, those types of things. If it's just a single family house, maybe they're coming in alongside you as a tenant in common investor where you're going to record their name on the deed based on their ownership rights. And so each deal, like I said before, uniquely different. But at the end of the day, you're still working with investors. There's still the reporting and the need for transparency. And there needs to be that understanding that, you are to some extent in the securities business because of that Howey test that I did mention earlier, which is basically the default. God forbid you ever find yourself in trouble. That's what they're going to basically point to.
So in what scenario can an investor come after kind of the principal of the company?
Any reason under the sun. I've seen the stupidest things. For example, when I was in the oil business, at a point in time when oil prices went from $36, $37 a barrel to $9. And it cost me at the time between $11 to $12 to produce the commodity. So I couldn't sell a barrel of oil at a profit. And so the decision that I had to make was to basically shut down my wells and sit on the reserves until oil prices rose once again, because the pump oil was losing $3 to $4 a barrel. Why would anybody do that? And so, one of my investors sued me. We went to court in front of a jury, I still remember, and it was a 2-day trial. And at the end, I won the case as the defendant. So I was completely absolved of all charges because the jury understand that that was the only choice. And I didn't do anything wrong, but I don't control the economy. I don't control the price of oil.
Sure.
So, at the end of the day, you've got to realize when you're raising money, people can sue you for anything. If you're doing real estate and the guy comes out to look at the house and he trips and falls coming up the stairs, can you get sued? Sure. Are most people going to do that? No. So you just have to realize that, money does funny things to many people. I mean, let's face it, it's the root of many divorces. People fall in love, and money issues
Yeah.
come up, and that love slowly dissipates, and you find yourself at divorce court. Same thing when you shake someone's hand and they give you a check and they become your capital partner. Things don't go as planned. You could find yourself, facing arbitration or facing litigation. And that's why it's always important to dot your I's, cross your T's, document everything, and use people that are going to basically work for you that have a reputation in the business you're in. For example, in the energy industry, when we were drilling, I was always using the best of the best on all of my wells. We had companies like Dresser Atlas, Schlumberger, Halliburton, Baker Hughes. I didn't have Johnny Smith and his brother that lived down the highway 40 miles, and so I knew if I ever had to go to court, I had all these big PhD engineers that I could point to get up on
Hmm.
stand with the biggest names in the industry. Well, that definitely worked in my favor. So, who you do business with also matters.
Yeah. Yeah. I think it's, when you're in, putting other people's money to work, I think, things, things can get pretty complicated
Yep,
quickly.
absolutely.
And it's such an emotional thing as well. So if I have an entrepreneur, they have a business idea, let's say it's some type of service business, or they're putting together kind of a smaller type local business, they're looking for 100 grand. They can't get a loan from a bank. They don't have the capital. They might, 5-10 grand that they can put to it. What's their next step? They don't
Mhm.
have friends and family. They don't know who to reach out to. What's their next step?
So here's what I always tell people. Number one is you need to put together a package. We call it an investor package. Most people are very familiar with the term pitch deck, right? So what does that look like? Well, it's a little PowerPoint presentation that introduces you, talks about what you want to do, maybe has some pictures, etc. And then you need to put together a little business plan or an executive summary. But then you got to find out where the investors are. And the great thing about our coaching and mentorship is we don't teach just one method of getting in front of investors. We teach about a dozen, because what will work for one may not work for another. And eventually you find one that works great for you and you just keep doing it.
Hmm.
But the thing that I always tell people is if you go to Google and you type into Eventbrite, or you go to Meetup, or you just go to Google and you type in investor groups or investor clubs, you'll probably find tons of investor clubs or meetups that are there in your neck of the woods. You probably have groups that are meeting every month for crypto, and you got groups that are meeting every month for real estate and to talk about the stock market. So you're going to reach out to the organizer to find out when they meet, and you start going.
Hmm.
Now, you're not going there necessarily because you want to invest in crypto. You're going there because everyone there is a qualified investor. And so you just start networking. You start explaining to people
Hmm.
what you
Great
do,
idea.
and what you find is many of them are going to have an interest, because when you start talking about buzzwords like, hey, we do this. I know our meetup is largely focused on crypto, but I'm a firm believer of diversification. And, if you want to take a look at what we do, it will definitely help your investment portfolio,
Hmm.
because as one investment zigs, the other tends to zag, and you'll get much more steadier growth. Before you know it, you're having lunch or breakfast with some of these people that you're meeting in all these different investor clubs and investor networking groups. And before you know it, people are opening up their checkbook. So that's just one, of many
Good idea.
methods, but it's the easiest because there are so many investor clubs and investor groups across the United States. And once people get to see you, once people get to look at you in the eye, shake your hand, and sit down with you, that trust is built much, much quicker.
Yeah. So you talked about the pitch deck. What are just a couple of things that an entrepreneur must have in that pitch deck?
So, number one, the most important thing, and this is basically something that was shared with me by Kevin Harrington, who was a speaker at my event last year. We do a big event every year, and we brought Kevin Harrington, of course, from the hit TV show Shark Tank. And he said, Brad, if you watch the show, which most people have at some point, you
Mm-hmm.
see great people that come on in the show. And many of them are very smart. They're PhDs, they're doctors. They've got a great idea. Better yet, they've even got a great product. But then they leave and they don't get funded. And the reason that a lot of them do not get funded is that in the pitch or in the presentation, they have not convinced the sharks that they can execute on whatever it is they're trying to do. And so the big key in your pitch or your pitch deck is you need to convince the audience that you or you and a team that you've built around you can execute on whatever it is you're trying to accomplish. And here's the thing, most people, when they start a business, are solopreneurs. You're spinning every plate, man. You're doing everything.
True.
Well, if you go to an investor and you say, hey, give me some money, what you need to show is depth in the business and say, over here, I've got John Smith. John is a partner in XYZ law firm, and he's the guy that's going to make sure we do everything by the books and stay out of trouble. And then over here, we work with the accounting firm of XYZ. And so Tim over here is a partner. He's going to be our bookkeeper, keep all of our records accurate, and send you the tax information at the end of the year. And then I've done this before. And so I've worked with XYZ company that's been my general contractor. They've got a tremendous track record, 20 years in the business. Essentially what you're doing is you're building what I call your power team. And when you can point to a team of people, your story becomes much more believable in the eyes of a potential investor, because now they see a much greater likelihood of executing on a strategy. It doesn't just fall on the shoulders of one person any longer. It's now you and that team of people. So I would say the most important thing of all is to convince the potential investor that you can execute on whatever it is you're trying to do. And then the second most important thing is the structure of the deal. Structure is actually more important than the strategy, because at the end of the day, investors are always thinking in the back of their mind, how's this deal structured? What does that mean for me? How am I going to make my money back? What do the returns look like? And so the structure is something you definitely want to always give some thought to.
Love it. Well, Brad, this has been fantastic. I think there's a lot of great information in here for people that are trying to get their businesses off the ground or maybe take them to the next level, and great information here about raising some capital to do that. Where can people reach out to you if they want to learn more about what you're doing?
Yeah, so a couple places. Number one is we're on all social media platforms. So, if you go to Instagram, just look for me. It's Brad Blazar. My last name is spelled B-L-A-Z, like zebra, A-R. There are no E's in there. And just, also be forewarned, there are some imposter accounts out there. So you're just going to look for me, Brad Blazar, on Instagram. Also, you can go to my website, bradblazar.com. And up there, I got information about my books. I'm a 3-time author. We've actually shipped my book, Winning at the Capital Game, all over the world. It's quickly becoming a top-ranked read for people that want to learn how to do this, as well as my other books. And so you can learn about our coaching, our mentorship, our boot camps, our events there. And then, of course, just on Facebook. So really just look me up, LinkedIn, Facebook, Instagram. The great thing about me is I'll respond back to you typically within the day, or one of my team members will. And just realize that we are here to serve and help people. That's why I created Capital School. I created it with the knowledge that this solves a major problem for people around the world. And that is, it gives them the real ability to raise money to do that thing that they've wanted to do in life, maybe for many, many years. Many people have had a dream or a desire to start a business, and it's not something that just popped in their head today. It's like, man, I've had this dream for like the last 7 years of launching my business. And I'm like, well, what's holding you back? I don't have the money. Oh, exactly. Okay. Well, let me show you how to get that, and let's make that dream you have a reality. And so when we get testimonials, Allan, from students, hey, I've raised my first couple $100,000, or Brad, thanks to you, I just, did my first real estate deal. Man, that just hits me in the right place, because that's the reason that me and the team we've put together here created Capital School. It's because we want to be able to impact and empower people and really help people make their dreams become a reality.
Love it. That's fantastic. All right, Brad. Well, appreciate having you on. Best of luck in all your future endeavors. Thanks, man.
Thank you so much, man. Great interview, great host. Thank you so much, Allan, for hosting me today.
My pleasure.
If you have enjoyed today's podcast, please leave us a rating. And for daily inspiration and business tips, follow Allan on Instagram. Until next time, remember, we build the future one entrepreneur at a time.